Hello and welcome to our second episode of Southbank Live. This is an experimental effort here at Southbank where we're trying to do a live stream format where we discuss the most important investment themes and items of the week, while at the same time taking live responses from our viewers. My name is Boaz Shoshan and I'm joined as ever by John Butler. John, how are you doing today?
Yeah, fine, Boaz. How about you?
Very well indeed. Very well indeed. I'm here
Good.
in Dundee at the moment, and
Oh,
it's the weather could be better, but it's still a nice city, even if it is rather muted. This week, but actually before we start off, there are a few items we'd like to cover. As of course, we are doing this on YouTube at the moment. If you're watching this and if you do enjoy it, do subscribe. It does help us a lot. And of course, in the chat box, if you have any comments or you have any questions about items that we are discussing, do just leave them there and we'll read them out if we have time. Some people have sent a few questions to me ahead of time that they'd like discussed. We'll try and get through them all as we go through the live show. But just to start off with, John, I thought the big question, the big theme we should tackle to begin with today is oil. You know, looking at black gold at the moment, some very interesting developments where we've got pretty high oil prices, relatively speaking, when you consider that the futures managed to trade down at -40 or roughly -40 last year. It's an incredible sight to see. We're now well into the 70s at this point. There's some very interesting conflict going on within OPEC when it comes to Saudi Arabia and the UAE. And I'd just like your general thoughts on that.
well, look, oil has been obviously a big story over the past year, both for reasons that have to do with the general global economic situation, but also idiosyncratic reasons with respect to the way in which the pricing convention for West Texas Intermediate takes place, and the fact that it's strictly physically delivered, the fact that storage costs at the margin can be very, very high. And so you ended up in this bizarre situation where prices briefly went negative. Now, leave that aside. The bigger picture is that oil prices went into the pandemic at a level which was sort of neither here nor there. That is, if you look at a multi-year chart. And that was a little bit curious because global growth was actually quite strong. And one of the reasons for that was that you had an undeclared price war a little bit between Saudi Arabia and Russia to basically just try to outproduce one another. Again, I say undeclared because you don't declare things like this normally. But in any event, so even though global growth was pretty strong, the oil price was not particularly high. But then, of course, the pandemic hits, price collapses. You get that bizarre negative price for a brief moment. But now look at us. We've come out of the pandemic. Global growth is currently strong. And so we've got an oil price which is significantly higher than we've seen for a while. And now OPEC is facing this situation, which seems like a nice problem to have. And yet you now have this sort of new spat or fresh spat with the United Arab Emirates saying that they don't like the previously agreed production targets. They think that they are being shortchanged. They're not getting their fair share of the pie. So, they're threatening to kind of spoil the party. So you'd think that, everyone would like higher prices, but the UAE don't think they're participating enough in these higher prices because they're not allowed to produce enough. And so oil actually came off very sharply. Over the past trading session, I think about 3% or so, but then it's back up this morning. Look, it's very volatile for a variety of reasons because things like this aren't terribly predictable.
Right. Yeah, it's interesting that sort of the conflict that you get between oil producing nations where you can't overtly declare an oil war, as it were. It has to be something that's sort of negotiated quite diplomatically. They have all these OPEC meetings and everything. But, John, I mean, oil is such a key input to everything. When we're talking about things like West Texas Intermediate, futures trading negative, Brent crude, all these terms like distillates and everything, to the everyman, it can often seem like very nebulous, very out there somewhere. But the price of oil in general is an input to so many things. Do you think when it comes to inflation statistics, generally speaking, so I think we're both on the same side that we expect higher inflation in the future, and inflation statistics are often, so much of that is accounted for via energy. Do you think these higher oil prices are going to lead to higher inflation figures? which then in turn lead to higher oil prices because people see the inflation figures and they think oil should be more expensive, which in turn lead to higher inflation statistics and so on.
Yes, to understand the relationship between oil prices and inflation, you need to step back a little bit and look at the big picture. Now, we know, of course, that the fossil fuel share of total global power generation and energy consumption more generally has been on a declining trend for quite a long time now. Okay. However, and this is an extremely important however, prices are set at the margin. And fossil fuels still represent the marginal energy production and consumption for the global economy. And of course, within the fossil fuel complex, the most widely traded, most liquid substance is oil, crude oil. And so that really is the global energy proxy that is referenced by all kinds of energy contracts. And as a result, that really is what if you're trying to think about the impact of energy prices on inflation generally, oil's as good as it gets. It really is telling you what you should probably expect, be it the short term or be it longer term. And this is where the longer term is interesting because you have seen a significant decline in capex by the major oil producers and indeed some smaller companies as well, but the major oil producers are the most important here. You've seen a significant decline in capex alongside this declining share of fossil fuels for energy consumption generally. And what that means is that if you step back from where we currently are, which is already an elevated oil price now, already inflation rising, you have a situation where if you wait a couple years, 3 years, 5 years, there's simply not going to be enough new oil production capacity coming online to keep up with even conservative estimates of baseline energy demand. And so that almost guarantees that we're entering now a multi-year prolonged period of generally elevated oil prices and therefore energy prices generally, right? Because again, oil sets the price, as it were, even for other substances and production.
It's the baseline, right?
Yeah.
I mean, this sounds great to me, John. As someone from Aberdeen, this is very good news. It's been a very grim time in Aberdeen over the past decade. There was one element of this which I find very interesting, which is just how severe the oil collapse last year has been when it comes to turning off oil supply, as it were. Because when you look to the costly forms of oil production, when you're looking at tar sands in Canada or ultra deep sea drilling in the Arctic and things like that, turning these things off, as many sort of companies were forced to do during the oil price collapse last year, they can't be turned on again very easily, and it costs a lot of money, in fact, to turn them off and to shut them down and things like that. So when we're coming back online now, it's like people are expecting that everything was the same as it was before the pandemic, and that oil supply is just going to arrive, and yet it's not. And there's a chart I'd like to show. It's just chart one. I'll speak to the man behind the curtain if we get chart one on the screen. And this chart is the Baker Hughes United States oil rig count. So this is the number of oil rigs in the US. It's generally seen by a lot of people as sort of a barometer for the number of fracking operations that there are in the US. And one element of this that I'd like to sort of expand on a bit is just how the idea that as soon as the oil price goes higher at all, that it's going to be met with a huge amount of fracking demand. This is an idea that has pervaded the investment space over the past decade, ever since the oil collapse post the 2011, 2012, 13 era, where we got that incredible surge to about $140, and then the fracking sort of surge just took it all offline. Ever since then, all of the mainstream investment community, as it were, have been expecting that just as soon as oil prices get very high at all, suddenly there'll be this vast deluge of oil that enters from the US fracking community, the boys in Texas, and that's just going to pull the oil price down. And so looking at this, where you see that the frackers are nowhere near where they were pre-pandemic yet, and we're already at oil price in the mid-70s, it makes me wonder whether or not, imagine if somebody threw an oil rally and the frackers never showed up, which seems to be what, nobody wants really to No, I've yet to find somebody who is sort of really betting on the idea that fracking does not make a big comeback, as it were. But John, tell me, what do you make of that?
Well, look, I mean, the oil market is extremely complex. Oil production is extremely complex. And if you don't work in the industry, you generally don't appreciate this, right? An oil well is not a light switch. You can't just turn it on and turn it off. Now, obviously, you have to drill it in the first place, and you're not going to drill it in the first place unless you believe that the oil price will remain high enough, long enough to make that particular well profitable. And so the risk calculations, the scenarios that oil producers will go through before they approve a project are extremely complex. And I worked on one of these many years ago. I was never employed by an oil company, but I was retained as a consultant by a major integrated oil producer, household name, to have a look at the economic outlook for deep water production.
Right.
Which, of course, up in Scotland, you're aware what this is, right? Now, deep water technology was developed initially in the 80s, but it didn't go online until the 90s. That's when the first deep water platforms were set up. And it was extremely expensive, extremely time consuming, extremely risky, and yet it's paid off. It's worked. But the fact is this: fracking is the same. You don't develop an entirely new way to produce oil, which is potentially a quite expensive way to produce oil, which will only be profitable if prices remain elevated. You don't go there unless you're very, very confident that prices will remain elevated. And here's where we are today. The fracking industry in North America is the marginal price setter for oil because they are the higher cost producers. Okay, but the thing is, fracking is a much more complicated process than just poking a hole in the ground and having oil come out. Okay, there's a lot that goes into it. You've got to pump water in to get the oil out. The pressure needs to be built up over a period of days, weeks. Look, it's not a light switch. Is the point I'm getting at. So we're not going to see the rig count go up unless people become convinced that oil prices are going to remain high for a sustained period of time. And right now, the curve is in strong backwardation, which suggests that, in fact, the market is not yet convinced that prices are going to remain high for an elevated period of time. And so we're going to have to wait a little while, as it were. And that could lead to a short-term price spike if demand continues to rise coming out of lockdown, et cetera.
Yeah, I mean, personally, I'm very bullish on oil. I think before the end of the year, we may even see $100 oil. I don't think that's out of the question. John, are you similarly optimistic, or do you think that eventually there will be, or at least in the nearer term at least, there will be some form of supply that will arrive and push the price down?
Eventually, yes, eventually, but it could well be that we briefly see triple digits before we see enough marginal capacity come online to relieve that. But the more general point from a macro investment point of view is whether we get that price spike or no. I do think we're looking at a multi-year period of generally higher oil prices. And until CapEx responds to those higher oil prices with some new projects, you're not going to see a general relief. And so again, we're talking years. And this is why I am concerned about the potential stagflationary consequences of what is developing in the energy market today.
Right. Now, we did actually have a question that was sent in ahead of time by a viewer. And this is similar. It's not focusing exactly on oil, but it's around this sort of topic. Oh, and just to anybody who is watching it, do feel free to ask any questions in the chat. I do note that there was somebody who was saying, will this be available to access later? If there'll be a recording available later. And yes, it would be. We will be making this public shortly after we have recorded it. It's currently almost 10:15 here on Wednesday the 7th. And we do get this question. I'm sure we are all aware of the world's and in particular this country's rush to reduce carbon emissions. However, it will take time. For example, what percentage of the Royal Navy's warships are not powered by oil, and when will that cease? When will there be sufficient alternative methods of electricity generation to supply all the demand of recharging the batteries of all those electric vehicles? I'm sure that no one except those with Trumpian views will not wish to protect the environment, but a realistic time guide would be much appreciated. and then says that they really like this format. Well, thank you very much for that question. It is interesting. The well, military vessels are probably not focusing on the environment first. It was an interesting proposal. I remember, I think this would have been back in 2019 in the EU, that said we need to start making tanks electric. And I believe this was a German initiative, which I thought spoke volumes of their where their priorities are. But what do you make of all that, John? When you're looking at how we can deal with reducing carbon emissions, would you think the green narrative as we've seen it, which is very, of course, anti-oil, I think it's quite bullish on oil, because effectively, like you said, they're not spending capital on producing more oil in the future. So these green initiatives to try and get rid of fossil fuels are actually will make them more expensive, more profitable to actually source. When it comes to electric vehicles and things like that, is that something that you think is overblown, or do you think this is very much here to stay and we're going to see more and more of it as the 2020s develop?
Well, look, I mean, to go directly to the question that was asked, look, what makes good politics doesn't necessarily make good economics. Now, we're living in a time where the environmental concerns associated with fossil fuel consumption, are really burning at fever pitch, right? And this is a trend that's not simply going to go away. And I'm not saying it should go away, but it's going to be staying with us for some time. But there are some areas of the economy where the transition from fossil energy to zero carbon or low carbon is going to be difficult, if not impossible, given all known current technologies. And military applications are one of those. It's a nice idea to extrapolate from automobiles to tanks. But if you look at the environment in which tanks are designed to operate, it's laughable. Okay, it's laughable. And let me get this straight. You're operating in the field against an enemy that's maneuvering in ways that you can't predict, and you're trying to get an advantage in those maneuvers vis-a-vis that enemy force. And you end up moving into a direction or an area where there happens to not be a charging station. It's just, I'm sorry, it's laughable. Okay, and obviously airplanes. Look, battery technology has certain applications that are perfectly reasonable, but you kind of need to support a heavy battery with gravity, something that sort of takes the load of the gravity. It's difficult to do that with aircraft. Okay. And so there's a reason why the only significant non-fossil, low-carbon energy source for military applications today is nuclear-powered shipping, right? Or submarines and surface vessels. That's where it really does make sense for large surface or also for submarines to use nuclear. It's possible maybe that there'll be a way found using very small reactors to power certain types of field weapons in the future. I don't know to what extent that's advanced. But anyway, look, let's generalize now. There are some areas where replacing fossil fuel is going to be extraordinarily difficult, possibly impossible. But that's not going to change the politics. The trend is there. Politicians will keep pushing. They'll push in every direction they think they can get away with because they figure it's a good way to get votes.
Right. And that will open some speculative opportunities, of course, when it comes to companies which will claim at least to be able to meet these new demands, these new targets by the government. And on that note, John, when you're looking at, I think, well, on that note, during the Cold War, there was an attempt to put nuclear generators on aircraft and to be able to have nuclear-powered aircraft. I believe it was bombers. It was probably Lockheed or somebody that was doing it. I remember seeing an old magazine advert for these things saying how they're helping the American effort. But I believe it was, I believe the idea was scrapped when you imagine what might happen if one of these aircraft were to crash. But it will be interesting to see how this sort of develops over time. Now, changing gears slightly to our next topic, I think it is sort of an elephant in the room here is gold. Of course, we are both you are a gold expert. I'm very interested in the gold space. We did get a question from a reader. I believe his name was Duncan, ahead of time, just saying, as I'm sure you are aware, looking at Gold Vault's chart for the last 12 months, price of gold is identical, $1,808 to the price on the 6th of July, 2020, by chance my wedding anniversary, just before the big push to over 2K. Will history repeat itself? Well, Duncan, I hope you had a very good wedding anniversary yesterday. But in terms of where we are with gold, it is interesting to see, year on year, nothing's happened. It's like, the pandemic never arrived, John. What's going on with that? What would you attribute to the past year? Because, of course, we should note that last month, June, was the worst month for gold, in dollar terms at least, since 2016, I believe.
Yes, I am surprised that gold is where it is today, given what has happened to inflation, which, of course, has risen from nearly zero in some places to now roughly 5% in some of those same places. That's a big move. And again, it's partly due to base effects, but it's partly not, in my opinion. However, I'm also surprised that global stock markets are holding up as well as they are at or near all-time highs, notwithstanding that being of potential concern, because of course at some point central banks might feel they need to start raising interest rates. But that's why gold is struggling. Gold needs more than a rising rate of inflation to rally. It also needs that rising rate of inflation to spark at least some modest amount of risk aversion, which simply has not happened. The fact is, even if you have a high rate of inflation, if you're invested in the stock market, you're invested in corporate profits, and other factors equal, corporate profits rise with inflation. And indeed, if it's a leveraged corporation, they will exceed inflation as long as that corporation has pricing power and can maintain its margins. And so, yes, you can just keep riding the stock market up to a certain point, but beyond a certain point, that inflation becomes economically destructive. It begins to crush margins and multiples, and eventually that shows up in realized corporate profits. We're obviously not there yet. So gold is going to continue to struggle, in my opinion, until at least some sort of risk aversion begins to creep into markets. We're going to have to see some profit taking in the stock market. We're going to have to see some fear. We haven't seen it yet. And I can't predict when we will see it. All I know is that the set of circumstances we're seeing now, which is excessive fiscal largesse on the part of essentially all major governments in the world, inflation already rising, commodity prices indicate and producer prices indicating more pipeline inflation on the way, and you have valuations, stock market valuations that are clearly stretched in any reasonable historical comparison. It really doesn't matter what metric you choose. That is certainly a recipe for a major market correction, double-digit percentage market correction. When it arrives, I think gold will at least hold its position, and it might well get a big boost right then and there. Alternatively, gold may merely hold its position while the sell-off takes place, but then gold will recover first once the stock market stabilizes. Those are the scenarios that I'd be looking out for now.
Right. And over, just over the very recent, past few weeks, we've seen a very interesting action when it comes to the bond market, where you've seen yields really get whacked down pretty hard. So there's been a very strong bid for bonds. And it doesn't, well, from what I've seen of it, it doesn't seem to have that yield relationship where lower interest rates equal higher gold prices. They don't seem to have been expressed too strongly, even though there is a massive bid for these bonds. Doesn't seem like that's trickling into the gold market yet, at least. It is interesting, that sort of fear element, John, when it comes to the investment community needs to see blood on the street before they will decide to buy gold. Is that just part of gold's nature, I suppose, where it needs to thrive on chaos, right?
It is. So and this, look, there's a lot of chaos and a lot of noise in financial markets. There is a very strong medium-term relationship between real interest rates, that is inflation-adjusted interest rates, and gold. It's the single most important explanatory variable in the medium term. But I stress medium term, and the medium term is designed to get rid of a lot of that chaos and noise. but it is real, right? That chaos and noise is real. And there's no way you can predict the fear and greed reflexes and impulses, animal spirits, if you want to call it what Keynes did. You just look, you just can't. All you can do is try to structure your investment process and your portfolio in a way that they are best suited to whatever macro landscape and environment you happen to inhabit. And right now, when I take a look at that, what I see very, very clearly is that there is simply an unreasonable lack of fear in the equity market and other risky asset markets, given this context of sharply rising inflation and a lot of pipeline inflation that is still on the way, that I believe over the coming months will demolish this transitory narrative that central banks are peddling and which a lot of people appear to believe.
Yeah, it is. The transitory idea. It's funny how these words just sort of arrive and then they stay for a long period of time. Transitory being very, very of the moment. Like with furlough and things like that. These words that arrive and they just become spoken and spoken, and suddenly everybody's talking about it. What do you make of the? What do you think the Fed? What is the role of the Fed when it comes to this discussion of inflation as being transitory? Do you think that that is the cause of gold having its worst month since 2016? Do you think it's enough people believing this and thinking that things are going to go back to normal to some degree, or at least that inflation is not going to be persistent?
That's my best guess. I mean, the Fed came out with a pretty uniform hymn sheet to sing from.
Yeah.
Other central banks are saying essentially the same thing. And while central banks certainly have lost quite a lot of credibility over the past decade or so, the fact they still have some. And if they come out with bold, clear, consistent statements, they will be able to buy time. They will be able to jawbone markets to some extent. I think they've clearly done that recently. But of course, it does mean that if I'm right and the inflation begins to appear more persistent than they have led markets to believe, then the potential reassessment is all the greater. And the potential damage to equity market valuations is commensurately greater.
Right.
So, now is the time, although I would expect many defensive and conservative investors have already taken action. But if you haven't, now is the time to protect your portfolio. Emphasize value over growth. Emphasize pricing power over growth. Emphasize basic industries over tech. And of course, blend in a substantial, and by substantial, I mean double-digit percentage portion of precious metals into your portfolio.
I should, of course, stress that in Southbank Live, we do not give personal financial advice or even general investment advice. We are just discussing the investment themes of the day. But when it comes to inflation, of course, I mean, the portfolio you would describe there, John, I mean, this is just one that is really primed to harness all of the chaos that inflation creates, right?
Absolutely, that's right. Again, you can look at any historical period in which money supply growth, credit growth, and eventually realized price inflation are elevated. Look at any historical period in which those conditions are met, and gold outperforms the stock market in every single one, without exception. Of course, there are brief periods of noise within that, but when you step back and look at your multi-quarter, multi-year periods, gold always wins.
Yes, it's interesting looking back at the 1970s. I always find where everyone thinks of 1970s being this big stagflationary decade, really, really good for gold. But, at the beginning of the 1970s, when you're looking at 73, 74, and 72, when going off the gold standard, of course, Americans weren't allowed to own bullion for a while at the beginning of the 1970s. But, here in the UK that you could. But during that period, during this grand inflationary decade, I mean, there were years where gold did really badly. Well, it wasn't a massive bull run all the way through. It was only at the end of this that it really gained momentum, and even then there were very strong corrections. So it is a process. It's not an event. And I certainly believe that what we're seeing here is yet another of these corrections, which will be so small that you won't really be able to even see it on a longer term chart looking back in the future. Now, John, just changing gears once again here, there was another topic I thought we should discuss this week, which, it's gotten a little bit of traction, but I don't think, I mean, even I'm just trying to sort of wrap my head around the enormity of it, what it really means, what's going on here, is the recent sort of taxation accord that has taken place, pushed by the US through the OECD, to get all of the major nations in the world to tax corporations at baseline rates. They're trying to create an accord that there's not going to be tax havens, and every corporation will at least have to pay some tax. It seems like if they manage to pull it off, this could be a foundation that is then used for much more aggressive things in the future. But then at the same time, they've given all of these exceptions to things like financial services firms, which some would say is, well, what was the point of what was the point of the whole thing if you're not even going to tax the guys who are dealing with all the money? So, John, what do you make of that, and how important do you think it is?
Well, look at the history here. This is not the first time that there has been pressure to try and harmonize global corporate tax rates. It seems to occur with some regularity. And indeed, the OECD is the organization most commonly associated with that. Now, as with many governmental or supranational organizations, the OECD's original purpose has almost nothing to do with what it does today. It was set up to help administer the Marshall Plan, because back when the United States was funding the reconstruction of Western Europe after World War II, there had to be some strings attached, right? The United States wanted the money to be spent, not only to be spent on certain things specifically, but they wanted government policies to also follow a certain amount of guidance, just general fiscal policy, general tax policy, etc. And so the OECD, of course, is no longer involved in administering the Marshall Plan, but that guidance on fiscal policy, on tax policy, remains very much intact. And there is this term that is bandied about by the OECD and others, which is called harmful tax competition. And so there's this concept that's existed now for years, harmful tax competition. Now, if you're a government, of course, you want to be able to tax, but you also don't want to be in competition with other governments that might run themselves more efficiently and have less need for tax, and therefore are able to offer global corporations lower tax rates. So there's this natural tendency, of course, to try and limit tax competition. And so Biden is in on this game now because he thinks that it makes political sense. And he's making an effort to, once again, try to harmonize global tax rates, I believe a minimum 15% global corporate tax rate. And he might well succeed. There are many, many governments who would love to have less competition from more efficient governments who are better able to attract multinational investment. So anyway, even if it goes through, there are always loopholes, right? So you can see the politicians agreeing this 15% minimum corporate tax rate and claiming credit and placating the masses by doing so, and looking all populist and looking out for the common guy. But then, of course, they'll start offering loopholes and rebates and everything else. And behind the scenes, the effective corporate tax rate is likely to be less. We've seen this game played so many times. So I actually don't think the de facto effective corporate tax rate in most countries is going to change much as a result of any of this.
Right. Do you think just the symbol of them actually putting it through, though, so even if you accept all of the loopholes, do you think that maybe that this example of, oh, well, we've managed to do this in the past, and building on that, we're now going to do X, Y, and Z when it comes maybe not into corporate tax policy, but other forms of fiscal policy as well? Do you think that that just the symbol of doing that could then be used as a springboard for something else in the future?
Oh, look, I don't think this effort will ever stop. That is, this attempt by large, powerful, heavily indebted countries to pressure other smaller, less powerful, less heavily indebted countries to do what they want them to do. I don't think that will ever stop. I mean, that's kind of the way the world works. Now, of course, there's a limit to how much power and force you can apply in these situations. But this is just sort of the way the world works. And, the United States used to not be a country with a huge debt except in wartime. But now it is, right? And in per capita terms, in national income terms, the United States is now a heavily indebted country, and it's only natural that it will start behaving in a different way as a result. And of course, there's common ground with most European countries who are also very, very deep in debt. You have Japan, which is deep in debt, although the nature of Japan's debt is very, very different than that of the United States, for example, whereas the US's debt is a part of a so-called twin deficit, whereas in Japan it's not. And I don't, it's a bit of a tangent there. But the point I'm getting at is that yes, this will not go away. Yes, this is a potential risk to financial markets because other factors equal, if governments are able to coordinate fiscal policy and able to eliminate competition, the overall burden, be it fiscal, be it regulatory, tax, etc., the overall burden on corporations is likely to rise in future.
Yeah, it is an interesting, example of it. John, when you're talking about the how countries behave differently when they become heavily indebted, right? What other traits would you associate other than trying to raise taxes and trying to sort of influence other countries to do it? What are the other common traits, would you say, of a heavily indebted country?
Well, obviously, you begin to have an inflationary bias in your policies because at the margin that erodes the value of the debt. And so, yes, I mean, we've seen this play out so many times before. I mean, in my book, The Golden Revolution Revisited, I write about what I call the monetary cycle of history. And indeed, becoming heavily indebted does tend to change the way in which you go about monetary policy and the inflationary bias of that monetary policy.
Yeah.
I think we have smoking gun evidence that the U.S. has kind of crossed the Rubicon in this regard. The United States Federal Reserve increasingly talks about inflation being a good thing, which is, again, memories are short. And while certainly I would hope a handful of people watching this episode will recall the 1970s rather clearly, nevertheless, memories are short, and a lot of people are too young to have those memories. And I mean, there was the famous Russian economist Kondratiev, who came up with this multi-generational long wave economic model based on precisely this idea that the only lessons we truly learn from are those we learn from our parents and grandparents. And once you get back far enough, you really do repeat history because you've lost your memory of it and you forget the lessons of it. And we're doing that now.
Yes, I of course am somebody who was not around for the 70s. Though it sound like I'm pretty lucky in that regard. I think they don't sound like a very good time to be around unless you were maybe a property speculator or something like that. One of the people who actually managed to make a huge bundle out of the inflation. So talking about with Kondratiev, the Russian economist, I believe he was he sent to Gulag or was he executed? I think because he displeased the glorious leader.
Well, sadly, I mean, you need to adjust this, right? The fact is, just about anybody who did anything that somehow could be interpreted by Stalin as counter-revolutionary was sent to the Gulag, and yes, that did include Kondratiev. Basically, Stalin wanted Kondratiev to conclude, a la Marx and Lenin, that capitalist economies were simply on this, on this downward path. Which was going to continue indefinitely. And Kondratiev said, well, there are times when it's a downward path and it can go on for decades, but they always seem to come back up again. And Stalin didn't like that part. So yes, that was the end of the discussion.
We do have a comment in the chat from Mike, who says, yes, the 70s really did suck. Good morning, Mike. Thank you for that. It is interesting hearing different people's experiences of the 70s. I remember doing this, I think it would have been in 2019, feels so long ago now, where I was just asking you, what was it like for you in the 1970s? And there were some really really crazy stories that people had of that period. But millennials like myself, we have no memory of it, and so we just pretend it never happened. And all the government intervention, no, that would never create something really, really bad like inflation. But it is interesting, as you say, John, that there is this attempt to make inflation be seen as a good thing. And yet, if you went to the average guy on the street and you say, everything's going to cost more, unless they're hugely indebted, it's not going to be interpreted as a very good thing. Do you think there's going to be a politician at some point who is so charismatic and so so populistic, as it were, so great at giving speeches, that they'll be able to convince people that inflation is a really good thing?
Absolutely, and indeed, this is what this is what again makes the political world go round. You do have you do have from time to time, politicians who feel that they can make a lot of capital by championing, this or that cause, which may or may not make any fundamental economic sense. But the fact is, going around promising people free ice cream is generally a vote-winning strategy. And it's a kind of a sad comment on human nature that that's the case. But this is one of the perils of democracy. Now, of course, as Churchill reminded us very clearly, democracy is the worst form of government except for all the others. But this is where we do need to retain a healthy degree of skepticism regarding the sorts of promises that politicians are giving us. And I'm concerned about that. COVID really changed the way a lot of people think, in my opinion. People who were at the margin, still skeptical that government fiscal largesse and inflationary policies were in any way a good idea. Some of them say, well, gee, it is a pandemic, right? We do need to throw money at the problem. Otherwise, we're all going to die. That mentality may have only captured 2, 3, 4% of the population. But if that's the 2, 3, 4, 5% that decides elections, we're in real trouble. And again, we have sort of crossed this Rubicon now where championing inflationary policies is somehow not just acceptable, but it's actually going to shift the balance of power such that the fiscal largesse and inflationary bias we've seen in policies over the past couple of decades becomes turbocharged.
Yeah, I mean, personally, I remain pretty amazed at just all of the things that governments got away with during the pandemic when it comes to spending, when it comes to adherence to lockdowns and things like that. But the bond vigilantes, the much feared bond vigilantes who are going to sell off government debt and as a result force governments to rein in their spending. They seem like an extinct species at this point. They don't seem to really be there.
They've been disarmed. The bond vigilantes have been disarmed by the central banks because the central banks have taken control of the bond market. However, you can disarm the bond vigilantes, but you can't disarm the currency vigilantes, the gold vigilantes, right? If they want to sell your currency and buy gold instead, they will. Now, clearly that hasn't happened yet, but there could well be a fiat currency race to the bottom, which some people think started years ago, but it could be about to accelerate. And you do see some interesting behavior, right? You have a number of countries that have dramatically accelerated their accumulation of gold reserves in recent years. And that includes Russia, which apparently now in its sovereign wealth fund has completely 100% divested of dollar assets. That may be symbolic vis-a-vis the rest of the world. After all, this is Russia we're talking about. But that doesn't mean the rest of the world isn't noticing and other countries aren't considering whether they're also going to need to protect themselves against an increasingly uncertain future regarding the purchasing power of fiat currencies, including the dollar itself.
Yeah, and on that note, looking at the dollar, John, as an American yourself, it was the 4th of July just a few days ago. It was weird. I mean, sometimes here in the UK, looking at what's going on in America, just when it comes to the general presentation of things from the government, there's things like adverts. For Brits, we interpret them; they seem quite strange. I'm sure it's the same for an American in Britain, but just the presidential message saying that the cost of a July 4th barbecue had gone down, and triumphing this, heralding this is a grand triumph of the Biden administration, that the cost of this barbecue has gone down. What do you think that says about the inflation narrative? Because for me, it feels almost like it's like they're worried that people are going to be afraid of inflation. So they're, hey, look over here. The price of this, this good that you would get every year, it's gone down. Therefore, inflation isn't here. I mean, that's the way I interpreted it. What do you make of that? Because it seems strange, but then a lot of American things seem strange. But like just the way that was sort of put forward as a symbol it felt sort of important to me as a signpost of something, but I don't really know quite what.
Well, this is traditional propaganda, right? It's not uncommon for a politician to speak out of both sides of his mouth, right? And to be supportive of inflationary policies on the one hand,
Yeah.
but then to be highlighting that the day-to-day food, clothing, and shelter that rank and file, hardworking people need to pay for, suggesting that those prices are stable or even falling, that can be seen as very popular. And it's traditional in the U.S. around Thanksgiving for the government and for other observers to calculate the cost of a Thanksgiving dinner. And in this case, it was a July 4th barbecue, which apparently was 16 cents less expensive this year than it was the year prior. Now, that said, seeing as how everybody was under lockdown the year prior, not everybody, but a lot of people were, one wonders what you're really comparing it to. But because you couldn't have your barbecue.
Right.
But look, it's yet more evidence, though, that the way in which inflation is measured is suspect. That there is overwhelming evidence that any reasonable like-for-like comparison, including the fuel for the barbecue, including the choice of meat to put on the barbecue, it's very, very difficult to argue that the price has declined over the past year. It really requires some twists and turns and hedonics and substitutions to arrive at that. I think anyone would agree that a like-for-like comparison would not have showed the price falling, but would have showed the price stable to higher, at least slightly higher, if not significantly higher. I know some people in the US who told me that they thought it was dramatically higher to have a similar barbecue this year to that they've had over recent years. In any event, politicians do talk out of both sides of their mouth. Like, inflation's good, but oh, don't worry, it's not going to impact your basic food, clothing, and shelter. Right. I mean, that's just not believable when you look at reality.
Right. Do you think, I mean, am I just missing that this is used quite commonly by politicians? Or do you think that this reflects a sort of a fear on the side of the Biden government that inflation is out of control?
No, I don't think they think inflation is out of control. And keep in mind that the United States policy elite, and this includes the central bankers as well as those in government, they believe that inflation is a nice problem to have. And the reason why is because it does help to erode the debt burden. But if, for some reason, the rate does get so high that it becomes a political problem, they at least know what to do about it. They know how to raise interest rates. They know how to squeeze money supply and credit growth. Yes, they know that that will cause a recession, but they can try to spin it this way, that way, control the narrative, come up with some exogenous, reason why the recession arrived. Take a look at what happened with Nixon and Ford in the early 70s in the U.S. They were acting as if what OPEC did to raise oil prices was a purely exogenous event. It's like, oh, those naughty Arabs increasing the price of oil to get wealthy when average Americans are suffering. How dare they? They caused our recession. That is complete nonsense. OPEC raised prices in response to the breaking of the dollar gold peg under Bretton Woods and the de facto devaluation of the dollar. OPEC was really just trying to protect their revenues in real terms rather than somehow throw the US into recession. That was pure narrative, pure spin. And by the end of the 1970s, nobody was blaming OPEC anymore. Everybody was blaming the United States policy elite.
Right. Now that we are sort of entering yet another subject, which I'm sure we could dwell on for quite some time, John. But we are getting sadly short for time. We're slightly over. We are sort of aiming to get within the half an hour to 3/4 of an hour limit. We did get some complaints last week saying we were going for too long, but I think we'll try and keep it that half hour, 3/4 of an hour for the time being. Thank you to everybody who did tune in. If you did like it, do give us a subscribe on YouTube, and we shall indeed we shall be doing another one of these in the future. If you do have any broader feedback, do send me an email. It's just boaz@southbankresearch.com. If you want there to be you want to suggest some future topics, for example. And we do get one extra comment from Mike saying, saying, I grew up during the 60s with inflation ever present for a long time. I don't see what all the fuss is about. Well, I guess we shall find out in the future. But as I say, if you do like the show and you have suggestions for it, do send me an email, or indeed just leave a comment on our next show. John, thank you so much for joining me.
My pleasure, Boaz. Until next time.
Until next time, we'll see you then.